Your Money, Your Life, Controlled by You podcast with your hosts Ashley Goins and Jackie Hendricks. Are you tired of feeling like you're losing control? We will use our knowledge and our experience to help you gain confidence in your ability to create a secure financial future and live the life that you desire.
Hello, this is Jackie Hendricks and Ashley Goings, your host for Your Money, Your Life, Controlled by You podcast. Now, if you look at our title, it's Your Money, Your Life, and it's controlled by you. And that's our major points of this podcast. What we really like to do, though, is, yes, we can talk about a lot of different things and we have fun doing that. But we would really like to hear from you guys and find out what you need to learn more about, what you would like to learn more about or know more about. So just follow us on our Facebook page. There's a place where you can ask questions, private message us, and we'd be glad to get back to you. Today, we're going to continue our discussion about Index Universal Life and the benefits that you can get from it. One of the benefits, and the way we get this benefit, is through what is called compound interest. Ashley, please tell us all about compound interest.
Good afternoon, good morning, depending on where you are in the world or in the U.S. First and foremost, compound interest is something that a lot of people don't understand. Your interest is earning interest. And I always tell my age with this one. Think about, the foundation of Lincoln Logs or Lego blocks. You've got to have a strong foundation to be able to go up to that next level. So if you think of stacking Lincoln Logs or Lego blocks one on top of the other, that's how compound interest works. So think of your principal, your first ever premium payment. We already discussed in the previous episode about how part of your premium payment goes into a supercharged savings account, and then the other part covers that cost of insurance. When you think about your supercharged savings account, that is where you're getting that compound interest. So that first bit earns interest. Then your next supercharged payment gets more interest. And then it just continues to stack on top of each other.
Basically, say I put $100 in for simple numbers. I get 5%, interest on it. The next period when they rate the interest, it's not just the $100, it's the 100 plus the 5, and then so on and so forth throughout the years. So that's how it builds up. But one key point about this, it's a lot easier for it to grow the younger you are.
Oh, yes.
The younger you are, the money has the key ingredient, and that is time. And that's why this policy is probably better for those who are younger as opposed to older. And now what we have done is we pulled some examples for you guys to share with you so you get a better understanding. If you want to know more about what your numbers could be and how this might work for you, go to our Facebook page and private message either Ashley or I. Will be glad to get with you and go over your numbers privately.
You brought up that we had already ran some numbers. I think it's very important at this point that we give true examples. We're going to look at a 30-year-old male versus a 50-year-old male, a 30-year-old female versus a 50-year-old female, just to show how starting it earlier can truly impact what your results are.
Let's start with the men.
Okay. Let's start with the 50-year-old male.
Okay.
So I'm gonna work backwards. On a 50-year-old male, now keep in mind these numbers can vary. They're not guarantees because it does follow the trend of an index. So right now it is following the best index or best performing index, which is the US Pacesetters. Based on that information for a 50-year-old male, and we're just going to use easy numbers here, and we're going to use the industry average for this type of policy, which is $200 a month. Now, again, if you want to know your numbers, please contact us. No matter what your budget is, we can help Strategically plan a policy to fit your budget and your needs. For this example, the 50-year-old male would actually have on the life insurance side of it, from day one coverage of being approved, $87,322 in life insurance. Now, on the supercharged savings account side of it, in the first year, you're going to have $1,573. And I know what you're sitting there thinking, but Ashley, I put in $2,400. Yes, but remember, it's split between the savings account side of it and the cost of insurance. Based on this number, let's be realistic. Most people aren't going to retire at 65. At age 70, his savings account side of it, which is 21 years into this policy, he would have access to $68,216 completely tax-free to use for whatever he wants to without ever having to prove hardships. If he wants to access it for a critical, terminal, or chronic illness, guess what? He goes into the life insurance side of it, not the savings account side of it.
Correct.
As time goes on, you'll start to see that not only are you still getting that compound interest, but your life insurance also starts to grow. Jackie, the reason that it does that is because you and I know, but our listeners need to know that in order for it to stay tax-free, your life insurance has to stay a certain percentage, and it does vary from carrier to carrier, but a certain percentage ahead of the savings account or accumulated value side of it. On this example, that actually starts to happen at age 72. This 50-year-old male started out with $87,322 for the life insurance. At age 72, it is now up to $90,356. And it continues to grow every year thereafter, just like on the compound interest side of the savings account. The longer you leave the money in there, the more it grows. That's the joy of compound interest. This policy actually covers you to age 120. So unless you know a secret that we don't know, not that we might not want to know it, to live to age 120, you can never outlive your coverage. And you have access to your funds at all points in time. You are in control of your funds. Now, Jackie, do you have the 30-year-old male pulled up on your side?
Now I'm going to be talking about the 30-year-old male. In this example that we're giving you, again, they're putting in the premium of $200 a month. So for their first year, they would have basically an accumulated value of $1,730. Again, that's less than the $2,400, like Ashley told you. Part of it goes to the savings account. The other part goes to help offset the cost of the insurance. Now, the net benefit at that time when you open up this policy and it's in effect is $182,211 that would go to your beneficiary. So should something happen to you. If we fast forward, and like Ashley explained, on the 50-year-old at age 72 is when their value of their life insurance started to go up at age 72. In comparison, for the 30-year-old, the life insurance starts gaining in value at age 56. The earlier you start, the quicker your numbers are going to go up because you have the benefit of time. That is so important here. Now, for the 30-year-old, we're not sure if they're going to end up retiring at age 70 or 72 or 74. It seems like the older we're going, the further out it's going. At least you will have things here in place that you can utilize during your lifetime. That's some of the benefits about this kind of policy.
Jackie, at age 70, what would be their value, just so they can get a true comparison as to the numbers that I gave and the numbers that you're looking at?
At age 70, it's $354,422.
And that's in that supercharged savings account side of it, correct?
Correct.
What's the face amount of the life insurance at that time?
The face amount of the life insurance would be $407,586. A big jump.
That's a huge difference. Huge difference. What we're going to look at now is the difference in women. On the 50-year-old woman, again, still using that same $200 example, at age 50, she starts out with $96,767 of face amount in the life insurance side of it. Again, first year, that supercharged savings account only has a value of $1,632. But we're going to go right back to that 70 age for retirement. At age 70, she would have $70,392 in the supercharged savings side of it. And her face amount is still the same that she started with. So that $96,767. It does take a little bit longer for her to see an increase in her life insurance side of it. So on the man, it starts at 72. On the women, it starts at actually 73. So that's $99,351 of face value of life insurance. And then at that point, her supercharged savings account with compound interest is actually up to $91,147.
The 30-year-old, again, puts in the $200 per month, $2,400 a year. Her accumulated value for the first year is $1,760. Her life insurance end of the policy would be $202,171. Now, if we fast forward, like she said, for the woman, it tends to be different. When the woman's insurance end of the policy starts to really grow is once she turns 58. So it's 2 years past the previous example. Now, when she gets to be about 70 here, she has $359,368 in her supercharged account. When she is looking at her insurance end of the product, $413,273.
We understand how beneficial an indexed universal life can be. When we look at this, and we talk about this all the time, it is your multi-tool. It is a Swiss Army knife of the financial and insurance industry.
It's a transforming robot, if you want to look at it that way, for your finances.
Exactly. And I know that we have talked previously about, it has these tax benefits, which is 100% true. It builds generational wealth. Again, 100% true. Our listeners need to understand that there are so many other facets that you can use this one product for. Think about closing your income gap, even replacing your income. College funding, that's huge to me, because unlike the 529 accounts, which we always talk about being controlled by the government, this way I can set my grandbabies up with a tax-free college fund, tax-free retirement that has a guaranteed income for life. You can put a guaranteed income for your lifetime and never have to worry about it. But then, Jackie, we've already talked about those living benefits. This is a new living benefit that just rolled out this past week with one of our carriers that changes everything. Jackie, will you share with our listeners what the two new living benefits are?
The two new living benefits they're riders. And we've already explained what riders are. One of the riders that is this new benefit that we're talking about is the fertility rider. It is fantastic because a lot of people in the United States are having to deal with infertility. Now, if you've never had to deal with that and you've been blessed with children, that's fantastic. But to go through the infertility, if you have to go through in vitro fertilization, it costs a lot of money. So this is going to help people who might be in this position. It's a great rider to have just in case, because I have seen the numbers go up in my lifetime of people who do struggle with this.
The second rider that was added is more geared towards Alzheimer's and Lewy body dementia. Lewy body dementia, of course, is the most common form of dementia that's been diagnosed. So they wanted to separate the cognitive impairment away from just your chronic, your critical, and your terminal illness. This is a diagnosis that we have seen a rise in since COVID.
The insurance industry is being very proactive and trying to meet the needs of their clients ahead of time. It's so important that they are being proactive and looking at a lot of the concerns and a lot of things people are dealing with today and trying to devise ways that are going to help these people.
Again, the importance of putting this type of policy or plan in place early is because you don't want to wait until a loved one is diagnosed with Alzheimer's, because that completely knocks them out of coverage unless it's a guaranteed issue. And we don't want them to go through that. So put a plan in place now that has the coverage and those additional living benefits as a proactive step, just like the insurance companies are doing.
And it's so important because we don't know. We want to protect our family and our futures. And this is a great way of doing it. Look at the IUL as part of your future plans. A lot of people have gone with the 401k, which is fantastic, but a lot of people have been hit hard too. So here's an alternative to having a 401k. Doesn't replace it. It's a way of creating a secure financial future for you and your family without Uncle Sam being in the middle of it. And you are the one who is in control.
And here's another great point is, unlike your Roth, there's no limitations as to how much you can fund this policy with. You can make $1 million a year. It will never knock you out of having this coverage.
One thing to consider, and like I said at the very beginning of the last episode, I've had people ask me, why haven't we heard of it? Well, a lot of times people use different names for it, like cash value life insurance. These are things that have been put into effect for a long time. Disney bought the land in Florida for this. Ray Kroc helped start McDonald's with a cash value life insurance. The J.C. Penney, a lot of the names we know and have grown up with. But we didn't know the backstory and how they got their start through using cash value life insurance.
Please fact check us on anything that we tell you, because we're not giving you misinformation. We want to make sure that you're educated and you're able to make educated decisions. That was our whole purpose in doing this podcast, is because we want to bring the silver platter with all your options.
Yep.
And you choose what your best option is. It's not that cookie cutter. And I wish I had a cookie cutter so I could just hold it up. But it's not that cookie cutter policy that every John Doe can go out there and get, because you do have qualifications for an IUL that you have to meet. Your health, your age, you want to make sure that you haven't aged out of starting a policy. And remember, you can start this on a child as young as 14 days old. Why are we as parents waiting? And I'm going to call out all parents, because I'm a parent, I'm a grandparent.
Mm-hmm.
Why are we waiting until they get in high school to start a college fund for them?
Well, I could give you a dozen reasons. I don't have the money. I don't have the time. I'm not sure if they want to go to college. But that's the great thing about this policy. You could set up this when they're very young and not for a lot of money in the account. And it will grow as they grow. And they can use it. Let's say they get to graduating from high school and they've developed a passion for race car driving, or not going to a trade school rather than an academia. This way, they can use the money any way they want. If they've created their own internet business and want to launch more businesses, they can use the money for that. They can use the money for anything. And that's the great thing about the IUL, or the Index Universal Life. Not only for the children, but for you. You can set these up, use the money how you see fit, help grow and protect your future. You can even get an income off of it in the long run. People talk about creating streams of income. This is an ideal candidate to look at.
Think about the bigger picture of this, though. As we've gotten older, and when we've, dealt with 401ks again, 401k has its place in this world. But think about not so much the college fund, but you're starting your child, your grandchild's retirement fund, to where they don't have to see the same losses that you and I have faced. That's huge.
Absolutely huge. And that's probably one of the greatest gifts we could give them. Everyone talks about Valentine's Day, which we just had, giving people things for their birthdays. What a better thing to help secure their future.
Jackie, what are we covering on our next episode?
On our next episode, we're going to be talking about what to look for in an agent.
Jackie, hold on. We're going to keep this in here because you're just being like super nice. Okay.
Oh,
but put it out there like it is. We had a griping session, shall we call it?
Oh, yeah.
To what people, like you said, need to look for and be aware of. Go ahead and finish us up.
It's really important to know what to look for in an agent. Make sure they're doing right by you, taking your best interest into account, taking your personal situation into account, and looking out for you in the long haul. This is not a one and done. So you want to join us next time to learn what to look for in an agent and an agency, and also a financial advisor.
Make sure that you like us on our Facebook group, YouTube. And if you have any questions, please, please, please reach out to us and we will answer your questions honestly and openly. Your information is proprietary. We do not share, we do not sell your information. So please don't ever think that. And we look forward to seeing you all next week.
Have a good one.